What stood out to you in the numbers that we got?
Well, it's another rock solid American jobs report, right? Even if it did come in below consensus, I think that's a good thing. We did need to see jobs hiring slow. We saw 33,000 jobs sort of adjusted for due to the auto worker strike. So the top line number actually understates the true pace and the overall scheme of things here. Look, right now, firms are having a much easier time attracting labor. We're not at that point where we can call this a red hot market. The trend is cooling. It's what we want to see. It's why bond yields are falling. It's why inflation is easing. Look, I think when we get into this, too often we fall into these false dichotomies of recession versus soft landing. I think what we need to do is start talking about this as it is. This is a very solid American economic expansion featuring historic rates of employment and a very low unemployment rate. Look, average hourly earnings, they're easing 0.2. Take a look at the 3-month run rate on that. You're going to get much more friendly economic and financial outlook. So I don't see here much not to like.
All right, Dana, Joe says rock solid. What say you?
Well, I still see three stories in the labor market. You have the companies that are letting folks go. There are companies that are hoarding, and then the companies that are still hiring. And it's still the same story. Companies that are letting folks go, those are the pandemic era darlings, and they're letting people go, such as finance and certainly transportation and tech. And that's understandable because they overhired and now they're right sizing. When you look at the jobs that are increasing, again, it's those jobs that are in person, or they're still trying to ramp up after the pandemic. That's government, healthcare, leisure, and hospitality. But in the middle, you still have a lot of hoarding. So this is the same story we've been seeing over the last few months. But we do think that we're going to continue to see softening in the labor market on the back of the Fed's extreme tightening of monetary policy. And we actually think that we will land in a short and shallow recession in the first half of next year.
Joe, you said there's not much to not like in this report, but how do you think the Fed sees it? I realize it's not just one data set they look at, but things pulling back just a little, right?
Right. They see a slower pace of hiring. We got a downward revision of 101,000 over the past couple of months. Yet people can get jobs very quickly. I noticed the median duration only 8.9 weeks. So roughly, if you're out of a job, you're getting one within 2 months. I mean, even before you get that first unemployment check in many cases. So I think the Fed's going to take a look at this and say, yep, you know what? This reaffirms our pause in November. I think it points towards an extended pause. The truth is, I think the Fed's done hiking rates. They will and they should at one point just get on with it and begin to think about stabilizing real rates, bringing down long-term borrowing costs for commercial and industrial loans. Our clients tell us they're paying double digits to finance payroll and expansion. So there's a lot of work left to be done. But as Jay Powell said at the end of his meeting, we're very close to the balance of risk being evenly distributed. That's inherently a bullish case for the American economy. And it's why, frankly, we just don't see a recession here right now.
Dana, how does the consumer see things? I mean, coming from the most recent Conference Board release that came out this week, consumer confidence regarding the employment situation, slightly fewer consumers were saying that jobs were plentiful compared to September. Numbers saying jobs were hard to get also declined. If the consumer is reading through this employment situation, what are they to take away from it?
Well, consumers are saying that jobs are hard to get and they're not as readily available. And that's consistent with what we've seen with the JOLTS data where, yes, companies are pulling down those job ads. And I think a lot of it's because, yes, you have some companies that are letting folks go, but most of them are holding on to workers. And I actually think there is one thing that the Fed wouldn't like in this report, and that's the fact that wage growth is not slowing. And that's reflective of the fact that companies are holding on to workers and they're advertising higher wages and raising benefits and comp and all those things to keep those workers. And that's all linked to labor shortages. So I think the labor shortage issue is leaning against the work that the Fed's trying to do to slow the economy.
Dana, when you think specifically on wage growth, I mean, the last several months have really been all about the strikes that we have seen. You've got the Hollywood strikes, you've got the UAW strikes, you've got hospital workers, healthcare employees also going on strike as well. I mean, what does that ultimately mean from a wage perspective when they have that leverage still? Partly, you could argue, because of a tighter labor market, to seek out higher wages and benefits.
Well, I think, again, that's a huge issue for the Fed that's difficult for them to control. When the laborers have the upper hand and they're saying we want higher wages, companies really don't have much choice. And indeed, our own survey of CEOs say that they plan to continue to raise wages anywhere from 3 to 5% over the next year. So that's going to lean against higher interest rates. And certainly we think that means the Fed, even if they're done hiking for now, that they're going to leave rates elevated for longer, and that the easing that may happen, it's going to be minimal. And then the ultimate Fed funds rate is going to be higher going forward than what we've seen over the last 15 years.
Joe, just to briefly follow on the strike theme here, I mean, employment in manufacturing decreased by 35,000 in October, reflecting a decline of 33,000 in motor vehicles and parts, largely due to the strike activity. All of this considered, when you think about how we now have to kind of calibrate future reports for where some of those jobs are going to come back, where ultimately the strikes and that consideration is in future reports as well, you know, what is that? How do we kind of readjust our calculus around this, if necessary?
Okay, that's going to reverse next month, right? And we can see what's going on in manufacturing construction. That means we're going to be opening new factories. You can see them along Highway 290 in Texas from Austin to Houston. These manufacturing plants that are going to be making semiconductor chips, which we're going to sell across the economy and all over the world. You know, look, you know, I'm a consumer and I'm looking at this report. You know what I see? 4.1% increase in average hourly earnings. That's above inflation. You know what that means? Income generated, positive income growth. We got a GDP that grew at 4.9% in the third quarter of the year. Over the last 2 quarters, we've had absolutely robust increases in productivity. You know what that means? Margins are going to increase. Guys, I got to tell you, there's just too much gloom and doom here on Wall Street. What's good is bad. No, that's not how the public's going to see it. And I don't think that's how policymakers are going to see it either. This is a good report. People are getting jobs. They're making more money. Employment remains very easy. The fact that you can, if you lose a job, you can get a new one within 2 months. That's an extraordinary statement. And look, the demographically induced changes that are happening in the country are going to guarantee that we're just going to have a tight labor market indefinitely. I think 4% is our new full employment. And anybody who expects the dynamics of the past 20 or 30 or even 40 years in the labor market to return, you need to take another look at what's going on in the data, and you take a look at what's going on in the country. This is good news, and we should celebrate it. Let it celebrate it. Like I said earlier, too easily we fall into that false choice or false dichotomy of recession versus soft landing. This is really solid business expansion, and we ought to note it as it is.
But Joe, where does that ultimately leave the Fed? If we need to come to accept here that the labor market's going to remain strong, right? I mean, Dana pointed to higher wages, employees still have more leverage. I mean, that's still inflationary. So what are the levers the Fed pulls if, in fact, this jobs market is here to stay?
All right, if I take a random walk off Wall Street, make a right and go over the New York Fed, you know what I'm going to tell them? Our star, the neutral rate, it's higher. We're going to have a much faster economy that can grow at a much lower inflation rate. We're going to have rates that are going to be higher for longer. I think the policy rate, look, we're not going back to zero. We're going to settle in between 3 and 3.5. You know what that means for the 10-year yield? 4.5 to 5%. If you're wondering about, wow, what's that going to do to the mortgage market? Well, mortgages are going to remain high or very expensive for a while, but I think they're going to drift back down in that 5.5, 6% region. That's going to be your post-pandemic era economy. We all need to begin to think about the shocks, the long-lasting changes, and what it means for policy. We're not going back to zero. That era of massive leverage is not coming back.
So, Joe, you're sort of arguing that what we have today is what we need to accept. That this isn't all doom and gloom, but it's also not going to change. It's a shift in sentiment.
Well, it's not. It's a shift in structure, more important, right? It's just that we're all going to have to learn to manage through and around the new realities of the economy, which is higher for longer. a quicker pace of inflation, which means higher interest rates. I think ultimately the Fed will lift their inflation target from 2% to 2.5% to 3% to acknowledge this reality, but well after the point in which it's already become accepted.
Dana, in the most recent consumer confidence figures, you also mentioned that more than 2/3 of consumers still said recession is somewhat or very likely. Does this report signal anything or show any signs of recession?
Well, I think the answer is probably no, right? Because labor markets react after GDP. So if you have GDP going negative in the first half of next year, then you'll start to see the labor market and payrolls go negative as well, right? You have to look at the timing. But I mean, I have to say that our outlook for the US economy is actually slower growth closer to potential. And inflation, if the Fed wants to keep inflation at 2%, and I don't think they're going to change the target because that would impact their reliability and certainly whether or not people trust what they have to say, then that means that they will have to keep interest rates higher. The bigger issue is still inflation. Inflation impacts everybody. And in our consumer confidence survey, most people were still complaining about higher prices for food, for energy, for prices in general. And so the Fed still needs to address this. And I don't think that we're going to see these outsized growth rates. Indeed, if you look back at the third quarter, you had some special factors that bolstered GDP. They're not going to be repeated in subsequent quarters. And consumers are complaining about incomes being slower, their personal finances not being as strong in the future. We can't ignore that and just look in the past and say, well, you know, everything was awesome earlier this year, but not look to the future.
Dana Peterson, the Conference Board Chief Economist, and Joe Brusuelas, RSM Chief Economist, joining us here to break down all things jobs. Thank you so much for helping us dive into this employment situation report. We appreciate it.